Welcome into the reaction channel, folks. Hope everybody's having a tremendous day out there. As always, got some important subjects to speak about in this video here today, okay? First video I'm looking to react to in this one is around rising rates and the impact on the stock market. I want to hear from these different individuals on the investment committee and kind of give my opinion and perspectives based upon that. Morgan Stanley's Mike Wilson says 5% dips in U.S. stocks is possible here, so that's interesting because I swear the man was just positive, but now I guess he's going negative. So looking forward to reacting to that one, what he's talking about there. From there, I want to talk about Enphase stock a little bit and actually share my opinions on that stock moving forward. And also, I was fortunate to stay away from that stock. A lot of people wanted me to get involved in that stock back in 2022, and I'll talk about what I could see in regards to Enphase that kind of gave me a little worry, so hopefully that can help you guys out in future stocks, okay? Then I want to talk about two subjects that I posted on X here today. One is, just a bit ago I posted this around how rapidly some of these stocks are flying up right now, and I mean, they're making investors an absolute fortune, and kind of what I see happening from here in regards to many of those stocks, okay? And then we're going to talk about Palantir in this video as well. Palantir 125 here today. We'll speak about my views. I did like a, question on X here today. Do people think it's going to be under 100 at the end of the year, 100 to 140 or over 140? I'll share my opinions and perspectives on where I see Palantir stock ending this particular year. So we got all that to get into. By the way, one thing only I need from you guys. And it's for you to smash that thumbs up button. I appreciate y'all for doing that. Hit the like button on this video. That's all I need from you. If you want to subscribe here to the channel, you can certainly subscribe. We're 94,000 plus subscribers deep now on the reaction channel. So all of you guys are in the first 100,000, which is very exciting because when you hit 100,000 on YouTube, you get a silver play button. And at some point we'll hit that, and everybody that's here now will be in that first 100,000. Additionally, if you guys haven't gotten to check out a video on the financial education channel, there was a video I put out last night kind of around my in-depth thoughts on the whole rate situation, what that means for the stock market this summer, and those sorts of subjects were covered there, okay? Alrighty, let's get into this.
Highest since October 23, 10 years on the move today as well. Jonathan Krinsky says the 30 years likely going up, and the S&P is going to work its way back to about 57.20 is the number that he has in his mind. How much of an issue is all this?
I think it's an issue. It certainly got everyone's attention, from the chief strategist types to the chief economists, but we front ran. Like, we ran up into this actual deal, and now yields are flat to lower today. So the big news has already taken place. The 10-year, which is basically unched today, is up 44 basis points for the month of May. It's a very dramatic move. It was at 13%.
Hold on. Listen, there's something very important going on beneath the surface in regards to sentiment right now that I got to explain to everybody because this is super important. Listen, if you look at consumer sentiment, can it get any worse than it's been over the last few months? Not really. Like, we're at about as low as you can possibly go when it comes to consumer sentiment. You look at those Michigan consumer sentiment numbers, like, they're below great financial crisis type levels. You can't get much worse than that. So the reality is consumer sentiment for the remainder of this year could really only get better. I mean, it's down so low, right? Investor sentiment. Could sentiment get any worse than it's been? Nope. If you look at, we had 11 straight weeks. 11 straight weeks of 50% plus of investors being bearish on the market the next 6 months. Go show me a time period where that's ever occurred before. Never happened. And they've been doing that survey since the 1980s. So the reality is consumer sentiment can only go up from here. Investor sentiment can only go up from where it was just a few weeks ago, right? And so that ends up making a very good feeling in the stock market, at least for the next several months, right? Eventually that will expire, right? And sentiment only lasts so long. But at the end of the day, I think we're going to be in a several month cycle of just sentiment getting a little better from the consumer, from the investors and things like that. And that matters significantly to where the stock market is headed.
On April 30th. So this has been quite a run. 2-year yields up above 5%. There were 2 yields left above 5% still. Everyone's really watching the 20-year, 5.09. For me, that's the bigger one than the 30. The 30 is the tail that gets wagged by that 20-year tail. And again, It's the highest level that we've seen since October of 2023, when the growth outlook, frankly, was much better than it is today. So it's a very strange situation we find ourselves in. My personal opinion is that the confluence of a slowing economy and the AI impact on the labor market in the second half of this year, which we're already started to see evidence of, those are disinflationary forces. I understand that the tariffs are inflationary, or at least on the surface could produce supply chain problems that become inflationary. I think the market has to decide which story is more believable, that we're going to have supply.
But here's my pushback right off the bat. He mentions, Josh Brown, JB mentions right there about, potentially negative impacts in regards to companies using AI, right? And, potentially firing employees or not hiring as much because they're using AI to have these jobs, right? Well, let's think about this a little deeper and how this affects stocks in the stock market, right? Because if you are then, let's say you're like, hey man, we could save $100 million or $50 million or $1 billion by doing this thing using AI instead of having these employees, right? What does that mean for a business model? Well, that means likely your margins are going to increase. Could be your gross margins. It could certainly be your operating margins and your net margins, right? Additionally, it means your overall net income is going to go up and earnings per share is going to go up as well, right? Because you wouldn't make that change unless it was going to help your margins and help your profits. Like, otherwise, why would you do that? It doesn't make any sense, right? So what happens when stocks margins go up and their earnings per share goes up? Well, their stock price also goes up, right? So that's another thing to factor in. You can say, well, maybe some jobs are displaced here and there, but at the end of the day, like if companies' margins go up and their earnings per share goes up, stock market goes up. It's a pretty simple game, right? So that's something to factor in.
Shocks as far as the eye can see, or that the labor market is cooling, the economy is decelerating, and inflation's not the real risk. My personal opinion, it's the latter. I think the Fed will be doing more rate cuts than people think today. And I think the economic data is trending in that direction. And I can personally look through a 20-year or 30-year north of 5%. For me, that seems like the head fake.
Shan, how big of an issue is this if rates continue to back up? For stocks.
Yeah, I mean, I think, once we start to get closer and closer to that 5% 10-year yield, then you start to see the impediment to, earnings, continued earnings appreciation. I think Josh makes a really good point, and I think it's one that we need to take a step back. There's a tipping point in the treasury market between fear and greed. And so if you're an investor and you start to see 10-year yields kind of crest up towards closer to that 5% yield, that starts to look really attractive, especially against the backdrop of, admittedly, shorter term interest rate cuts. Those are, we're going to continue to see the curve be pretty steep here.
They're obviously tracking one another, rates and stocks.
Right.
If you look at the movement today, for example, it's a pretty good indicator about the relationship between the two. You're looking at the 10-year. The 10-year yield moves down as we approach showtime, and the stock market moves higher. If rates were to reverse again, you start to get more nervousness. The Nasdaq obviously had some pressure on it earlier because rates were moving up. Now they're moving down. Nasdaq's green.
But the difference today between what we have seen over the past couple of years when we've seen rates on the rise is the fact that these rates are rising based on deficit expectations, fiscal sustainability concerns. They're not rising because we anticipate that we're going to see this kind of meaningful, economic shift.
Oh,
like
people try to make the argument, though. There's some in the newspapers today that are trying to suggest that all of you and a lot of you are making too much of the fact that rates are backing up because of concerns about the deficit, that it's more to do with expectations of higher growth. Now, you can say that's complete nonsense. Yesterday seemed to be a pretty good indicator of what the real deal appeared to be.
If that's the case, though, Scott, I think the difference here is, too, if we were banking on the Fed to get really accommodative to continue to engineer economic growth in the second half of the year into 2026, I think that's more of a concern but the Fed is a policy taker right now. They're not a policy maker. And so we're looking at the fiscal situation. Our view is that rates are moving higher based on those concerns and that there is continuing to be some catalyst in the second half of the year and into 2026 for economic activity to grow once again based on improved business confidence.
In fairness.
So let's talk about the consumer in the economy for just a moment here, right? Because I actually think the consumers could be in a very good spot for the next couple of years. Here's why. Specifically for the remainder of this year in 2026, 2027, here's why. Inflation's dead. Dunzo. People are paying cheaper gas prices, way cheaper gas prices. They're actually experiencing deflation when you go to the gas pump, right? And if I just look at like price increases, it's not happening. If I look at real estate, all I see is price cuts. All I see is rents either stable or going down, not increasing in all the markets I pay attention to. And that's in real time. That's like right now. So and those are some of the biggest costs that people have, right? And so at the end of the day, inflation's dead. Meanwhile, wages are still increasing. They're not increasing rapidly, but they're still going up. And the masses are likely about to get a tax cut starting next year, right? Some people, it might be an extra $1,000 in their pocket. Some people, it might be an extra $5,000, $10,000. But at the end of the day, it's extra money. So when you have dead inflation at the end of the day, people still got their jobs, right? And wages are still increasing, and inflation's dead, and the cost of housing, if anything, is going to go lower, at least as far as rents go, right? Mortgages are a little complicated because of mortgage rates right now, but if I look at the absolute price of homes, there's no doubt in my mind at all, they're decreasing across the board in the United States right now. Are we experiencing a great financial crisis where home prices are going down 50%? No. But there's no doubt in my mind we're in a downtrending housing market now at this point in time, right? Which, by the way, if you're looking to buy a house, could make sense in the next year or two to go ahead and maybe potentially look into that, right? Now, keep in mind, mortgage rates are really high right now, but do keep in mind, like, sometimes it's better to buy something when prices are really attractive rather than when mortgage rates are really attractive. Because if mortgage rates go down, a year from now or a few years from now, you can always refinance. So that's something to just keep in mind there. But the moral of the story is, in regards to the masses, which is the masses are the economy, I think things are looking better for them over the next few years versus saying they're looking worse.
Joe, the economy's holding up better than many people thought, okay? The consumer's been holding up better than people thought. I'm not suggesting that no part of the move in rates is anticipating a stronger economic backdrop, but there seems to be no denying the fact that if you're going to pass a $4 trillion tax bill, that given where the deficit already is and the cost of funding it is already a concern, you're gonna have a backup. Now, on the issue of the economy, Citi today talks about, quote, the calm before the storm, that they do expect growth to weaken in the second half. I have to tell you, I just got back from CNBC's CEO Summit out in Arizona, and to a person, you didn't really hear much gloom and doom out there at all from the CEOs who were in attendance. In fact, it was quite the opposite. Boom. I can tell you, corporate leaders like the rest of us are wondering whether the soft data is eventually going to turn up in the real.
Boom. That's the thing. You got to understand, business is still strong. Listen to the company conference calls from all the big dog companies out there. Or do they all have doom and gloom, horrible numbers, horrible guidance? No, that's not the reality. Numbers look really good. Guidance looks really good, right? Ad rates on YouTube. Obviously I'm on YouTube, and ad rates, looks fine to me. If we're in really bad times, I'm sure Google ad rates would be going down substantially because business would be like, we're going to have to pull back on advertising or something like that. Like, I'm not seeing any of that reflected in ad rates that are shown here on YouTube or any of that. So, yeah, there's a lot of worries. The sentiment's all concerned, things like that. But you look at the numbers. I mean, Marriott CEO, I just heard from him today. He said, everything was fine. March was a little weak, but, it's all good. There's a lot of scared sentiment, but the numbers, at the end of the day, they're coming in. So just something to kind of keep in mind.
Data and bleed into the real numbers. Here's Marriott CEO.
Even Wynn. Oh, they're going to talk about Marriott CEO. This is perfect. Even Wynn Resorts, you listen to them. Does Wynn Resorts sound like it's the end of the world? Absolutely not. Listen to our latest conference call, and you'll be like, looks pretty decent out there.
Tony Capuano with me on stage.
I think the reality is this. Our business thrives in times of stability and high consumer confidence. Neither of those have been in ample supply in recent months. However, the fact that you've seen this fundamental shift towards prioritizing travel and experience, We just did Q1 earnings. We beat on almost every metric. And we would have beat a lot stronger if not for March. January and February, we came out very strong. Then you saw a little bit of shock to consumer confidence in March.
All right. I mean, the point, Joe, is like everybody's talking about. All right, surveys have been horrific. We all know that. The data has not, the hard data yet.
The perception, awful, pessimistic, but the reality is simple. The S&P is up 7% since April 30th, and during that period, the 30-year has rallied 50 basis points. I believe that what we have witnessed in the last 3 days is that bond markets, and not just U.S. bond market, but global bond markets, have basically said to the equity market, hold on, we're taking away your permission slip to go to the all-time highs. I still think we are positioned to go that way. And the technical reasoning for my belief there is as long as we maintain above 5650 in the S&P, we could do that. But this is not just isolated to the U.S. And that's why I don't think this is really bonds are rallying on the expectation of growth. This is about long yields in Japan at their highest level since 99. We're seeing the same type of behavior in the bond markets in Germany, Australia, and the UK. So this is a global question where bond markets are saying, okay, what do governmental balance sheets really look like? And we're going to continue to have this need to borrow. I think what that means is we're in this moment where the S&P rally is probably on a pause until we resolve this. And I think, again, you look towards positioning. Central banks and pension funds are not coming to the rescue to be buyers of government bonds. That's not what's in front of us.
You still, according to Tom Lee.
You know, you got to think about what type of stocks are really in prime position for the next 12 months at least here. I'll tell you the type of stocks that are not well positioned. It would be anything high ticket. Because high ticket, right, that is debt. Think of it as rates matter significantly. I'm talking homes, people buying homes. I don't think home sales are going to be great for this next 12 months if rates stay up. Now, if the Fed also starts cutting like crazy and also in the 10-year, tanks or something like that, that changes the profile. But assuming the Fed, they gradually cut, the 10-year remains kind of in a high threes, low fours, something like that. I think when it comes to the home builders, I think they'll do decent, but I don't think they're going to do great. Auto sales, I think, are still going to be in a tough spot. Furniture sales, stuff like that, big ticket, because a lot of people take out debt to go buy a brand new living room set and those sorts of things, right? On the flip side, what does really well, because you got to understand, for people, money keeps stacking, right? At least if you're in a halfway decent financial position, because you got your job, you got your wages, you got your business, whatever, right? Meanwhile, you're not having to deal with inflation anymore at this point in time. And so your income versus your expenses, if anything, is going to start looking even better and better as this year continues along, right? So what do people do? They're going to go out and spend on smaller ticket purchases, things that they don't need to finance, right? At a 7% plus mortgage rate or at a 8%, auto loan rate or something like that. So they're going to say, screw buying the house right now. That takes a huge down payment, or screw buying a new car right now. I'll keep driving around what I've been driving around the last 4 years, right? 5 years, 6 years, 7 years, whatever. Screw buying new furniture, stuff like that. Let's go out to eat. Let's go buy a new pair of shoes. Let's go buy this or that, right? So they'll do a lot more of those $50, $100, $200 purchases. But they're not necessarily going to make the $700,000 purchase right now of a new home. They're not necessarily going to go buy the new SUV for $80,000 right now. So that's just something to keep in mind here. If and whenever rates come down, then we could actually see things flip a bit, and people could go back to big ticket purchases. They might go buy themselves a new boat. Okay, baby, we're going out on the river. Okay, maybe not the river, the lake. We're going to go buy ourselves a new boat, okay? Go get some jet skis. We're going to go get some furniture. We're going to go buy a new house and big down payment, right? And go buy a new car. Some point that part of the cycle is going to be there, but it's not going to be there in the short term. Short term, next 12 months, it's really going to be small ticket purchases, and expect companies that sell small ticket items. Don't be surprised if they do very well. I'm even thinking about a company that I don't own right now, but a company like Bath & Body Works. I wouldn't be surprised at all if Bath & Body Works numbers look very good as this year continues along. Because at the end of the day, people got money in their bank accounts, man. They like to go spend it. And, they can't spend it on big tickets, so they're going to go small ticket.
Jim, have firepower, his word, to drive stocks to an all-time high. We're only 5% away on the S&P. You know, before you had the little bit of a tantrum yesterday, right? Last week before I went out west, we were talking, well, the S&P is only 4+%. We're 5% away from a record high in the S&P 500.
So big surprise, Scott. I'm pretty optimistic. I think this was a stock market that was looking for a reason to consolidate, and it got one. But let's parse through what is happening.
Ooh, I like this. So the Dow's about 7% off its highs. Dow would be doing a lot better if it wasn't for United Health. UNH stock, and by the way, I spoke about UNH stock a few days ago on the channel here, okay? S&P 500 is down about 5% off of its highs. Nasdaq off about 6% off of its highs. So, you know, if this is 2018, like I told you guys, if this is 2018, we're going to hit new highs in the stock market in June or July. In all the indexes, June or July, we're going to hit new all-time highs. If this is 2018, which is what this year is reminding me so much of. It is ridiculous how much this year is reminding me of 2018. So if it's 2018, in June or July, we will hit new highs in all of the indexes. We'll see. That's going to be even crazier if that ends up happening. Then it's like, we're going to really look like 2018.
In the bond market, I mean, the 20-year and the 30-year, and Josh, I think you were alluding to this, but you kind of pulled your punch. Who actually buys those? It's the people who buy those are insurance companies, pension funds that have long duration liabilities. I got it. You know what matters far more is the 10-year, because that's what businesses key off of in terms of their capital expenditures. And the 10-year, I'm not going to look right this second. What is it, 4.58%? I'm not freaking out about that. Now, yes, you go up towards 5, there's going to be a hiccup in the markets, unquestionably.
Rate of change, too. We can't always speak about absolute levels. They're almost meaningless.
Scott, I agree. We always have this conversation. I'm not denying what you're saying. I'm not. But what I'm saying is, actually, the 10-year has been kind of stable for a while. It popped up to 4.8, whenever that was, April. Got back down to 4.25. If you really look at it, and I'll give Ed Yardeni credit, he's been calling this.
I wish I had Mr. Shorthill's Capital on, and him and Shorthill's Capital be arguing left and right now.
We're just kind of stuck in this
We're in a range.
4.25 to 4.75% return. So I'm not looking at that. And I'm also going to say one more thing. Reason I'm optimistic, what you were saying, Joe, about international bond yields, yes, it's because there's borrowing and there's going to be growth from it. There's going to be growth. European defense companies are going to grow on this. So are American defense companies.
Fair play. Question is, how much does Palantir grow on that? Okay. All right. Next up here, Morgan Stanley's Mike Wilson, and then we'll get into some other important subjects and some stocks and some opportunities and some millionaire makers and all that good stuff.
Thanks, Bro. Really?
If that was a dip, right?
If that was a dip, define a dip here. What kind of dip would you buy?
I mean, 1% sell-off isn't really a dip worth buying. I would say 5% is a dip, 10% is a correction, 20% is a bear market. That's kind of the way we talk about it. So we do think a 5% correction or dip is possible based on the move in rates. That's kind of been our view. And quite frankly, we're still stuck in that range that we identified earlier this year, 5,500 to 6,100. So we got closer to the upper end of the range. Now we're going to get a dip. I'd be surprised if we take out the 5,500 unless something really, deteriorates again on the tariff side, okay? And we go through that in our mid-year update. Like, a lot of things now have turned the corner from a rate of change standpoint. That's going to make it hard to return to a sub 5,500 price in our view.
Is the tariff the only left tail risk? Because it seems that a blown out deficit with this new tax, this one big beautiful bill, is concerning markets, at least when you look.
One big beautiful bill. By the way, there's good deals all over this market, right? I'll be doing my buys tomorrow, right? But I'll show you good deals all over this market, okay? We can pull up some right here, baby. There's good deals all over this market. And I'm not just talking about small caps or some hidden stocks. There's ones right in front of your face. Look at Meta. You're going to tell me Meta at, a little over a 24p is not a great deal today? Of course it's a great deal. It's a huge money maker, right? It's a double-digit top-line, bottom-line grower. Like, come on, man. Look at Google McDougal. Google McDougal's at a 17 forward PE with double-digit top-line, bottom-line. Adobe, this is a SaaS business model at the end of the day. This is just like recurring money coming through, right? Adobe at a 20 forward PE with double-digit top-line, bottom-line growth. Come on, man. These stocks there's just easy buys all over this market. And I showed you AMD before, right? AMD, think about the type of growth rates AMD is going to be putting forward starting in the back half of this year and then as we go into 26, 27. At a forward P that's still in the 20s? Come on, man. There's a lot of steal deals in this market. I'll be doing buying tomorrow. I'm looking forward to it. I buy every single Friday. And so you don't need to go out to, and then there's obviously like and we'll talk about more of these type of stocks in a moment, but then you got, these sorts of opportunities that are turnaround plays that I think have huge upside over the next 2 or 3 years, like Nike, EL, stocks like that, right? Even though this market I know has come back strong, we're still significantly off of where we were, a few months ago, and there's still deals all over this market.
Rates, right?
Well, that's right, and that's exactly why we can't break through to the upside, because there's two things going on the rate side. Number one, you have excess supply. The deficit now is a problem again, potentially for the bond market, but also the Fed's on hold, right? The Fed has been a bit, overly focused on inflation, and so you don't have any rate cuts in the near term, and you now have this supply risk. And the fiscal deficit blowing out. So that took rates back about 4.5%. That's always been our level where multiples come in. That's a 5% move historically. That's not a 10%, 20% move in isolation. Now, if that leads to something else where we have another growth scare, for example, because rates are higher and all of a sudden recession risk comes back on the table, that's a whole different ball game. That's not our view.
Okay, so for long end rates, at the very least, at what point do they become a bigger problem for the equity market?
Yeah, I think 5% is where it becomes a real headwind for
10-year.
Yeah, for consumer, like everything's priced off the 10-year, right? So then all of a sudden you're looking at, oh my goodness, we have now recession risk potentially is back on the table. But in that instance, just think about it, the Fed will act then, right? I mean, so we have this sort of, it's going to be back and forth like this for the next 3 to 6 months. The way you got to think about the first half of the year, most people came in very bullish. We came in more, not that bullish about the first half because of the sequencing of policy. But that policy now has flipped to a more pro-growth sort of stretch. And that's what the market's going to start to think about. That's why it's going to be really hard to take out 5,500.
That is, by the way, my question of the day, Shonali. Like, at what level do yields really start to put pressure on stocks? And you're saying 5%. Goldman Sachs was out this morning saying 5% as well. Chris Waller was speaking, I think he was on Fox this morning. Are you looking at me funny?
Yeah, I forget exactly where he was as well. I just saw the headlines.
Okay, but he was saying, like, if tariffs stay at 10%, the Fed is good to go in terms of cuts in the second half of this year. What are you expecting from the Fed in terms of stimulus? Because that is important to the stock market at the end of the day.
I think it's critical. It's another factor, though, the rate of change is going to turn more positive. Don't forget that, the big rally last fall was driven by Fed cutting into an economy that was fine. And then they stopped in December. That was really the beginning of the correction that we saw, not tariffs. Okay. So, yeah, I think that the Fed will be either communicating that they're turning more dovish or they'll actually be cutting. Our official House view is no cuts this year. But then they have 7 cuts for next year with no recession.
Yeah.
So that's pretty bullish. So, I mean, if we get 7 cuts with no recession next year, stocks are not going down.
7 cuts with no recession. Yeah, well, fair play. Okay, so looking at this one, end phase here, right? I said, put this out to the private stock group. I said, I'm so happy I stayed away from this one. It had a ton of hype in 2022. So many people tried to get me to buy it. Yes, there was especially a lot of retail investors were involved in this one, right? The stock was doing very well in 2022, while it seemed like everything else was crashing. Yeah, if you think about 2022, I mean, stocks like Shopify fell 70, 80%. Netflix fell 70-something%, right? Netflix got all the way down to $165 a share. Meta obviously fell to $88. I mean, it was devastation all over the place when it came to tech stocks, right? Nvidia stock is up like 1,000+% since that particular low in 2022. To me, it felt like a company that was just benefiting from a short-term solar boom, and the bust cycle would come. That bust cycle has come. Stock is down 80% from those 2022 prices. Yeah, you look at Enphase stock, it was well over $300 a share back in that kind of October, November time frame there. And, since then, obviously, it's devastated. And it's gone down so much now that it's negative on a 5-year basis. So even prior to the whole huge move, you've lost over 15% if you've been investing in the stock the past 5 years. And that never mind if you were obviously buying up here at $200, $300+ a share, right? So, sometimes you just got to stay with your conviction, even in a tougher market. If you see, if people are making a bunch of money from stock, that's good. But at the end of the day, when I looked in this company, it seemed like a company that was just benefiting from a lot of short-term stuff that was going through. A lot of excitement around solar. Solar business was kind of flying high. really in Rona time, then into 2021, even into 2022, you had all the Biden stuff, the Inflation Reduction Act, and all that excitement that was going on there. But it seemed like as rates went up higher, because a lot of people would take out debt to finance this solar, right? It seemed like it was just not going to end up being the play, right? And people still kind of piled into it. And I'm like, geez, this is risky, man. And I've spent so much time, obviously I've lived in Vegas the last 10 years, and so I know these solar companies very well, as far as at least all the solar sellers, and it was a hot business, man. It was a hot business to be in. It's as cold can get now. It's as cold as cold can be when it comes to kind of the solar business now. It's a tough sell to people, to tell them you're going to sell them this big thing. And people are like, I don't know about this, and trying to finance the costs and things like that. And plus, there's just been there's been a lot of momentum lost in like clean energy and the excitement there, EVs, solar, all this stuff has lost a lot of power, no pun intended, over the last number of years. Like there's not even remotely close to as much positive sentiment around electric vehicles now. Solar, we're going to save the planet, save the globe. And I think a lot of that's driven by obviously the top of, when you think about who's the person that was behind a lot of this, is Elon Musk, right? And with Elon Musk kind of change over the past number of years over to the right, a lot of people kind of said, wait, do we even believe in this like EV stuff? Do we even believe in, climate change? Like now there's a lot of questions. So it just lost a lot of momentum, man. And so now it's gone through a bust cycle. With that being said, probably a lot's de-risked in the stock now, but still, just not a company I'm looking to be in. It's just not my cup of tea, just to be quite frank with you. No, we got some stocks that's making people fortunes out there, right? ELF is up 67% since April 17th. AMD is up 42% since April 9th. Palantir is up 55% since April 9th. Tesla's up 54% since April 24th. SoFi since April 9th is up 39%. And the thing that's important, by the way, if you ever want to follow me on X, I always have that linked in the description area down there. And then the pinned comment down there today I'll have is my private stock group. If you want looking to apply, join our private stock group, private wealth group, get access to my private Discord chat, all the course curriculums, all that good stuff, 1000xstocks.com. You can certainly apply. That's with the pinned comment. But the description area, I always have my X page linked. And the moral of the story is you got to act fast. When you're in those major corrections and crashes, you got to act fast. You play around, you wait, you think, and you try to play it cute, like, it's going to go down a little bit more, I'll buy next week, blah, blah, blah. You could completely miss it. And the scariest part is, look at the moves these stocks have made. The market's not even at all-time highs. Now, let's just fast forward. Let's assume this is 2018, and we're going to hit new all-time highs in June or July, right? How much do you think these stocks are going to be up by that time? At a market at new all-time highs, with investor sentiment, let's say, gets a lot better. Consumer sentiment, my gosh, then we're going to be talking about these stocks are up 70, 80, 90, maybe 100% from where they were in April at the lows. So you got to act fast when you're in those major corrections and those crashes, because, you don't get a lot of time. You don't get a lot of time, man. Especially nowadays. The market moves so fast. The market is so drama now. The market gets so freaked out so quickly and then recovers so quickly. It used to take a year, 2 years for the market to go down, right? And just kind of it would slowly go down lower and lower and lower. Now, it seems like it just crashes and then comes straight back, right? We're in a way, the news cycle moves so much faster. The way things play out moves so much faster. Everything is so much faster nowadays. So instead of a gradual move down, now it's boom, you're down. All of a sudden, look at the Nasdaq. The Nasdaq from that February 19th high, right, to where it was at the beginning of April, it fell 25%. 25% in a major index. And the Nasdaq is not some kid index anymore. This is not, 2000. That's the big dog index now. That's probably the index that honestly matters the most of any of the indexes, even more than the S&P 500 nowadays, right? And it moved down 25% that fast. The S&P lost 20% without any concrete hard data, just off of sentiment about, what's going to happen with Trump tariffs? We're scared. 20% down. And then you get these rapid recoveries. And you go look at Rona. That was another great example. S&P 500 went down almost 35% in a matter of a few weeks, right? And then started to come back very strong. The comebacks take more time than the downfalls because we're humans. And so humans get scared faster than they get excited faster. And so, the downfalls are faster than the up cycles are fast, right? But the up cycles are much more powerful. They're like a tsunami, right? Versus the crashes are like one big wave comes in. So they're different, right? But it happens quick, man. So you can't get cute around pricing. Now, I talked about Palantir. I said, what's your end of year price target for Palantir? At that time it was 125. I think it ended at 122, right? He said under 100, 140 or over 140. So the stock could go over 140 and end this year over 140 if the growth rates just keep accelerating. They got to keep accelerating. Not like they got to keep growing strong. You got to accelerate the growth. So next quarter has to be well over 40% growth and then like 45% growth and then pushing up to 50% growth. If they could do that, then you could be talking about stock that will end this year over 140. On the flip side, if we start seeing a deceleration in the growth rate next quarter or the quarter after, then I think the stock will get hit pretty heavily and it could go down to 100 or even end the year below 100. So it really comes down to what is that revenue growth doing? If you keep accelerating, stock's got more upside. I know the valuation is ridiculous on Palantir, right? But the valuation for Palantir, it doesn't matter right now. All that matters is the growth rate accelerating or decelerating. And until that growth rate starts to decelerate, right? So instead of growing 40%, they grow like 37%. Until that happens, people are going to be happy buyers of the stock. The moment you start to see that growth decelerate, it's going to be a tough time. It's going to be a tough time for Palantir for a while, especially if then you're talking about the growth keeps decelerating. But for now, it's just a lot of excitement. You got new deals. Yesterday, if I recall, they just got a new contract worth several $100 million at Palantir. So right now, it's party on, man. It's just been party. At some point, the party's going to end, right? And it's going to be an ugly ending when it ends. It's going to be an end in a big fight. But for now, it's party. Other than that, there's still some great opportunities out there. I think Nike remains a great opportunity. EL remains a great opportunity as far as some turnaround plays there. So you definitely got some of those opportunities. Amazon's always a buy. We know that, right? We spoke about Google, McDougal. We spoke about Meta, Adobe, some of those sorts of stocks, okay? All right, guys, appreciate you joining me as always. Thank you so much for being here. If you're looking to apply to our private stock group, private wealth group, 1000xstocks.com, get access to all that. Pinned comment down there. Click on that, fill out a form. We'll see if we can get you access to all that. Maybe next week at some point in time. I know a lot of you guys got Monday off, so if you're looking to get in on Monday, that might make sense if you got Monday off, okay? But that'll be pinned comment down there to apply for that. And other than that, check out some videos on the main channel as well. I've got some bangers on there, so a lot of videos you guys will enjoy. Much love and have a great day.